what is going on in the world of bonds. Treasury bills, bonds, bonds are down. Let's say bond funds are down.
Yeah.
Treasury bills feel like they're up. What we see on our statements are confusing. But now, we're looking at another graph that I think is a little simpler graph in that it just kind of shows you the waters we're swimming in right now. This is 2022. The price of the bonds have gone down significantly, and this is an example here. And I think this is to the first slide. Interest rates went up, and the price of these bonds went down.
So yield, and that gold line or yellow line, yield went down.
Yeah.
I'm sorry, yield went up, right? 4%.
Yeah.
So we had that immediate shift down in price.
Mm-hmm.
And then we were able to hold those bonds for that 20-year investment horizon.
Yeah. So it's fascinating because this feels painful. And when we look at our statements, we go, this is where we're living, and it's hard. Why would I not do something, sell those things, buy treasury bills, do something different? When in reality, the terminal wealth, and I love that term because it requires me to go, okay, my statement right now is painful, but when do I need this money? And we're going to talk about that too in a minute, and how we can, how we have some strategies for that. But I'm actually going to be better off, in the not very distant future. And I'm going to be significantly better off down the road. And this applies to everyone, Andy, whether you're saving, whether you're in retirement, this is beneficial, but it sure doesn't look or feel like it right now. But this is the math. And this is to your point earlier, and why it is beneficial to own bonds now and how you can benefit from it. But it sure doesn't feel that way. And that's hard to, it's hard to merge those ideas in our mind anyway, what we see in our statement versus my future terminal wealth. So.
Yeah, I think that's spot on, Charlie. If I can buy bonds now or own bonds that give me 4%, then over that investment horizon, and then that's a better outcome for me as an investor. And then I think what we're probably about to talk about, Charlie, is, well, what about on the short end, right? How do I protect myself if I'm a retiree and I'm withdrawing funds today?
Yeah, absolutely. And this is a framework, the way we think about, especially as someone approaches retirement and is in retirement. And sometimes, well, not everyone, it just depends on the client circumstances. We might physically separate accounts like IRA bucket 2, brokerage bucket 3. We can do those things physically, but more importantly, it's kind of a framework of thinking about these investments. Right now, this bucket number 2, and we've used this for a while. It's basically for interim, 5 years down the road income. And so we know that this bucket is going to fluctuate. Let me draw an arrow like this. It's going to fluctuate down some and up some, but not that much. Right now, we've probably seen the most fluctuation in history of this bucket number 2, 2022, I would say. Now, this is bucket number 3, and here's the fluctuation here, or volatility. It's going to be a lot, right? But this is income, even in retirement, you're not touching for a long time. In this situation, 7 or so years away before we ever have to worry about these. So we can allow this to fluctuate over the long term. We know if history repeats itself, it'll do okay. And this bucket is less volatile, but we know it still has the potential to go down, which is where we are right now. So why is it okay, Andy? We were talking, before, like, why is it okay if I'm a retiree, I see my bonds going down? How is it possible that I'm still going to be okay? Is the question I was asking. What do you think?
Yeah, I think you're about to hover right over it. But if we go into that bucket 3, right? So if you're a retiree, I think, sorry, I guess bucket 1 on the left there. Yeah. So if I'm a retiree and like, hey, I've got these bond portfolios going down in value, right? Well, how can we mitigate that? Well, like anything else, we tie our investment objectives and the risk we're willing to take to our investment timeline and horizon. So if you're withdrawing funds right now, you probably want to have that short-term bucket,
Yeah.
number one there, that keeps a sizable portion of your living expenses and everything you need as a retiree, right? Available to you, which isn't going to have, will have almost no volatility, right? So in other words, very little fluctuation uh, in price. And so we can do this, right, in portfolios. And I think that gives investors peace of mind knowing, yeah, I've seen volatility in the portfolio in my bucket number 2, right? And then in my bucket number 3, but I've got the cash on hand over the next 6-12 months that I need, right? To keep me, to keep the lights on, if you if you will, right? So
absolutely.
that's how that's how I think about Charlie, and maybe you'll kind of go into that, what that bucket number 1 looks like here.
Yeah, I think we've listed. I switched slides here and listed just some of the examples of things, and you notice we say short-term bonds because those are closer to the, like you think like a CD that matures in 1 year or 2 years. That's the same with short-term bonds, and they will fluctuate even less in value. But now is a great time for this bucket, is it not? I mean, T-bills are a good example. CDs. I mean, you can go to your bank and get between 4% and 5%, maybe even more, depending on if there's some kind of a bank that's offering higher rates. So this is a good time to have a bucket 1. You can get interest on your short-term money. That's great.
That's right.
And it's actually a pretty decent time for bucket 3, especially this sector right here is doing well. The others are doing so, but nonetheless, this is the one that we see on our statement that really hurts us, especially again, if you're close to retirement, in retirement, you see that on your statement. It's frustrating, but we don't, that's okay. Your plan is still intact. Your income plan is still intact because we've got a design such that money's coming from here. When this bucket goes down and this one goes up, Andy, we can actually do a rebalance, take the gains from bucket 3 and replenish bucket 2. So that allows us to sell high and buy low. And that's, you and I know that as rebalancing. That's not some kind of magical solution there, but that's just typical rebalancing.
And what's funny about that, Charlie, is you're saying sell high and buy low, which is 100% true on the price of the bonds, right? But if we go and we buy into bucket number 2 now, you're also selling high, right? But then buying higher interest rate bonds, right? So it allows us to go in and buy some more of the bonds that are at, yielding 5%, right? So we can now generate more income because we're buying more of that bond fund that is rebalancing itself as well into those higher yielding bonds. So there's some goodness there from a rebalancing perspective.
Yeah. So, I hope that helps. And one of the things that I just want to stress is that, what we see on our statement and this current time, it doesn't mean the future is dark for our portfolios, for our retirement income. It actually means there's a little more opportunity for especially for retirees, near retirees, because those higher interest rates are going to be beneficial in a lot of other ways. So, but it's very hard to disconnect when I see something that I own in my portfolio that's down. It's hard for me to go, yeah, but the future is brighter. And that's not just a sales pitch. That's the math of it all, So hopefully we can separate those two things. And that graph that shows that terminal wealth to me is really impactful.
Yeah, no doubt, Charlie. I think if we're an investor who's tired of living in the age where you were getting maybe 1% yield on your bonds at those days, you can never predict the future.
That's right. Yeah.
Right. And nor will I ever try. Yeah. But I think we're entering a new era of maybe a more normal interest rate environment going forward, which I think is a good thing for investors in the long term.
Yeah. The last thing I'll say before we close out, and we kind of didn't address, like, why would we own bonds? As you're like yourself, you're a younger investor. Why would you own bonds? Maybe you don't. It just depends on the circumstances. But a younger investor, a non-retiree, I should say, bonds are still a great holding because when we go into a recession again, we will again at some point. It's part of the business cycle, economic cycle. Those bonds are usually, give us diversification and allow us to minimize losses, and so they still hold those diversification benefits. And so that's why a non-retiree could benefit from bonds. And so that's one of those things that we don't want to forget about as well. So they're still good. They're not real sexy right now because the price is down and it hurts, but the future seems brighter. And they're still a great thing to have in your portfolio, regardless of whether you're in retirement or a younger investor as well, depending on your circumstances. So, all right. Any closing thoughts, Andy?
I've enjoyed it. Thanks for bringing me on, Charlie.
Absolutely. Feel free to reach out to us if you have any questions or if there's anything you'd like us to address. You can reach Andy at andrew@leadingedgeplanning.com and charlie@leadingedgeplanning.com. Go to our website, send us a message through there if you would like to as well, at leadingedgeplanning.com. Thanks for listening. We hope it was helpful, and enjoy your fall and Halloween, Thanksgiving season.
Leading Edge Financial Planning, LLC is a registered investment advisor. Advisory services are only offered to clients or prospective clients where Leading Edge Financial Planning and its representatives are properly licensed or exempt from licensure. For additional information, please visit our website at www.leadingedgeplanning.com. The information provided is for educational and informational purposes only. It does not constitute investment advice, and it should not be relied on as such. It should not be considered a solicitation to buy or an offer to sell a security. It does not take into account any investor's particular investment objectives, strategies, tax status, or investment horizon. You should consult your attorney or tax advisor. The views expressed in this commentary are subject to change based on market and other conditions. These documents may contain certain statements that may be deemed forward-looking statements. Please note that any such statements are not guarantees of any future performance, and actual results or developments may differ materially from these projected. Any projections, market outlooks, or estimates are based upon certain assumptions and should not be construed as indicative of actual events that will occur. All information has been obtained from sources believed to be reliable, but its accuracy is not guaranteed. There is no representation or warranty as to the current accuracy, reliability, or completeness of, nor liability for, decisions based on such information, and it should not be relied on as such.